Worst month of the year, but I don't know. Maybe the tide's turning. What do you think?
Well, in the last 2 weeks, tech is actually up 5%, and that's 35% of the S&P 500 if you include comm services. So I get it. They got oversold, but Scott, XLK is still up 38% year to date. So I wouldn't be surprised to see just some consolidation. What I have been encouraged by is the broadening in the market. In the past month, the XLE has outperformed the XLK by 770 basis points. And the XLI, the industrials, have outperformed the XLK in the past month by 200 basis points. So the broadening out is healthy. It's because the economy has hung in, minus the jolts, although jolts are still well above historical averages. But I understand why the yields are falling on the news today. But I do think the economy is hanging in pretty well. That's what we learned from Powell last week, that the economy is strong, labor market's still tight, and inflation, though, is still persistent. So data dependent, we're all data dependent, and that's exactly what's happening today in the marketplace.
Hey, I said yesterday we made this checklist, Jim, of the sort of the things that have to go right for September to not live up to its billing of being this historically weak month, although maybe not so much when you've already had a pretty good run into in August like we've had. And economic data being good but not too good was high on the list. Now, jolts, check. Right? Fed wants the labor market to cool a little bit. Confidence, check. Consumers still doing well, but let's not get off to the races any more than we already have. Is now we about to turn the calendar? How do we see this?
Could go either way. I mean, I'm data dependent. The Fed's data dependent. The markets are data dependent. And to your point, Scott, you know, September 1st, this Friday, first day of the month, what do we get? We get the labor report. Everybody's going to be paying attention to average hourly earnings, non-farm payrolls, et cetera, as the first tell for what inflation did. Not a direct reading of inflation, but the first tell of what inflation did in August and what the Fed might do in September. I still think at the end of the day, this is about inflation and the Fed. Although that story's pretty long in the tooth, it is pretty long in the tooth. But Steph made a good point about the broadening of the rally. Okay, I want and you want that broadening to continue. I think it will continue if the Fed is done. If the Fed is not done, we're still going to be doing this hand-wringing about a recession.
We're not going to know, you know, for a minute whether the Fed is done. We had just in the last week or a couple weeks, you know, suggested, well, the mind of this market had changed. It became no longer a buy the dip market. It was a sell the rip market. I mean, the activity of the last week or so would suggest otherwise.
Boy, how it changes quickly.
That it's back to, to buying the dip. And by the way, HSBC today says we think this presents a pretty good tactical entry point into risk assets, above all into U.S. equities. We've seen in many respects, Josh, the correction that hasn't happened. You know, we started to get a little bit of an upset in the market, and then the conversation was, and all the notes were, all right, we are going to have a bigger correction. We could go down 10%. We're due for it, blah, blah, blah. Well, the S&P's down 2.2% in the month of August, which was so terrible. Not really.
I have to be honest with you. I think our committee absolutely nailed this summer. We were long and strong through July, one of the best months ever. And then in August, during that pullback, I can't think of anyone, any of our regulars in the cast, that said anything other than it's just a little bit of sell the news combined with seasonality, and it's August. Like, these were, you're talking about companies that came in, reported earnings with their stock prices up 20% from May, reported amazing earnings, sold off 5%, and people were ready to call for the next bear market. We didn't do that on this show. We don't get everything right, believe me. Especially not me, but to a person, Stephanie, Jim, I think we all said stocks are up a lot. It's okay if they retrace some of that rally on a sell the news reaction to earnings. That's all it was. We didn't get more dramatic than that, and so that's what we're living through right now. I want to say one thing here, just statistically. Try and understand this. The VIX is now sub 15. It's back at 14.5. It's down 4% on the day. The VIX is down 15% in the past week. That entire volatility spike was from the sell the news reactions in earnings. There's no other news that generated that. I'm sorry, but the Fed's speech was milquetoast. It was exactly what we thought it would be, maybe even more bland. So the VIX hit its low for the year in June. That was probably too low at 12. We had a roaring rally in July. and then we gave some of that back.